Hi friends, today we will talk about mutual fund investing. This video is dedicated to the young blood, the generation X, people who want to invest early in their life. This video will not tell which are the best mutual funds, but we will discuss the most critical points and the pitfalls of mutual fund investing. We will discuss the process to select a good mutual fund. Mutual funds are meant for those people who don't want to invest directly into stock market because selecting a right stock is a tedious job and a very time-consuming process. And conversely, mutual funds are managed by dedicated and capable managers, and they continuously strive to generate higher returns for their investors. So let's start by examining the key critical points while selecting a good mutual fund. So on the screen you can now see a popular website which lists different mutual funds, and we can also compare them here. We have different websites on the internet to compare mutual funds, and we can select any one of them. More or less the features remains the same. So we will just zoom it out so that all the options are visible clearly. The first important classification is category. There are 5 broad divisions visible here. Debt mutual funds invest in the debt market. Equity oriented mutual funds invest in stock market. Hybrid mutual funds invest in both debt and equity market. Other mutual funds invest in either indices or in overseas funds. And last, we have solution-oriented mutual funds. They invest in specific solution-oriented funds, such as either for retirement planning or for investment on your kids. So they have a predefined purpose. However, discussing all the types of mutual funds will make this video very long. So we will restrict the discussion towards only equity mutual funds, because for younger generation, equity mutual funds generate highest returns and they are best for long-term investing. After selecting equity mutual fund, we can see 12 different kinds within equity category listed here. So let's examine and check each one of them. Contra funds invest in those shares which are contradiction to the given trend of the market. It means that if in the current market IT or pharma stocks are in favor, then these funds will invest in other sectors such as maybe infra or maybe oil and gas. So they try to select contra shares which are not in flavor right now, or maybe they are undervalued, and in near future they have high probability of giving high returns. The next category is dividend yield mutual funds. These funds invest in those shares that give high dividend yields. Those dividends are credited into the trader's account regularly. These kind of mutual funds are suitable for the people who are happy to see small amount of dividends regularly flowing into their accounts. Although in most cases the returns of dividend funds are a bit less than the general other categories. The next category is ELSS. ELSS stands for Equity Linked Savings Scheme, and these funds are used for tax saving purposes. Next category is focused mutual funds. In focused funds, the number of shares are very low. That means they have a very concentrated portfolio of selected stocks, and the fund managers believe that these stocks will go higher in near future. Next one is large cap funds. Large cap funds invest in the top companies that are listed in Indian share market. So basically, if we arrange all the companies by their market capitalization, large cap funds invest in the top 100 companies listed there. So by definition, large cap companies are those companies which are the top 100 by market capitalization. Consecutively, mid-cap companies are those companies from rank 101 to rank 250. So the next 150 companies are mid-cap companies, and small-cap companies are from rank 251 to 500. So these 250 companies come under small-cap, and beyond 500, then we have ultra-micro companies, micro companies, and so forth. So the next category we have large and mid-cap mutual funds. So they will restrict themselves to large cap companies and mid-cap companies, which translates to top 250 companies in Indian share market. Then we have mid-cap mutual funds. These funds will invest in mid-cap companies. The next we have multi-cap funds. As the name suggests, these funds will invest in a mix of large cap, mid-cap and small cap companies. Then we have small cap funds. These funds will invest in small cap shares, basically from rank 250 to 500. Then we have sectoral or thematic mutual funds. These mutual funds will invest in a specific sector, or they have a specific theme in their product portfolio, such as maybe infrastructure or oil and gas or pharma focused mutual funds. The next category is value oriented mutual funds. These funds try to pick up shares that are undervalued right now but have the potential to grow big in near future. So these stocks are not generally into limelight. The next one is flexi cap fund. These funds invest across all sectors, and their allocation to large cap, mid cap and small cap varies depending upon the condition of market. So they are flexible in their market capitalization, and hence they are called flexi cap funds. So this was a broad classification of equity oriented mutual funds. The next parameter is risk profile. And based on your risk taking capacity, you can select from the different options that are listed here. Generally, low risk mutual funds are those companies which are too big to fail. So the risk of the share falling too much is very low. And on the other extreme hand, we have very high risk companies which are very small and their potential is yet to know. And it is also possible that the returns are negative for these companies. But if they start climbing or they are in the uptrend, they can give very handsome returns. So the risk parameter depends on every individual. It makes sense to have a basket of mutual funds based on your risk profile. You can include a few low risky and a few high risky funds to average out your returns and have exposure across all sectors. The next one is fund size. At most places it is also called as AUM or asset under management. It shows that how big is that mutual fund, or simply how much money that mutual fund is managing. Although AUM or fund size does not give a clear picture of any mutual fund's performance, because there are some key parts to it. Firstly, if a mutual fund is listed since a very long time, many people would have invested in it, and that will increase the fund size of mutual fund. Conversely, if a mutual fund is relatively new, its fund size will be very low as compared to an existing mutual fund. So it is unwise for us to compare returns from a large fund size with a mutual fund with a small fund size. Also, when you grow too big or the fund size is very high, it becomes difficult for the fund manager to select new stocks and invest them, because the money which is flowing in is too big and the stocks which are there in the market are limited. So the fund managers have a difficult job in selecting a good share. However, sometimes a small sized fund does much better than a big size fund, because its fund manager have a lot of opportunity in picking up different stocks, as their fund is in quite younger stage and they have a lot of opportunity of selecting and picking up good stocks. So fund size is not a criteria for evaluating future performance of any mutual fund. But yes, larger mutual funds have a trust factor in them because they have been in the market for so long, and small fund size mutual funds are relatively new, so they are a bit risky. The next criteria is available to invest, or simply the mode of investment. The two modes listed here are, one is SIP, the second one is one-time investment. This again depends on individual to individual. SIP stands for Systematic Investment Plan. That means after you select a particular mutual fund, a certain amount of money is debited from your account every month and then invested in that mutual fund. So for the debited amount, whatever is the NAV of that mutual fund, the number of units translated will be credited to your demat account. And by one-time investment, you invest as per your choice. You are free to select the amount and you are free to select the timings also. Both the investment mode types have their pros and cons. In SIP mode, you don't have to track market movement. A certain amount is debited on a fixed date and the units are credited to your demat account. These units are purchased on the NAV of that given day. However, if you track the market, it is wiser to invest one time, or maybe in 2 or 3 months you invest lump sum whenever the market comes down and the NAV falls to a certain level. This might generate little bit higher returns than SIP mode. If you are taking the SIP mode, then note that according to different studies which were done previously, it is better to choose a date of around 15th to 16th of that month, or either 27th or 28th of the month, because it is found that investing on these dates have generated a bit higher return than the normally selected days, which is generally in the first week of a month. This is because mutual fund companies try to extract as max as possible from a customer. So they know that in the first week of month, salary is credited to their clients' accounts, and as soon as the salary is credited, they want to debit the amount. So generally demand is higher in the first week of the month and it's lower in the middle. But if you want to invest intelligently, then do select dates of around 15, 16 or 27th or 28th of the month. This will generate a better return for your investment. Now let's move on to another website to compare and see few other parameters. Now we can see another popular website where we can compare mutual funds. There are different filters available here. The first one is fund house. You can select any particular fund house if you have any inclination towards them. Some people try to invest in a particular fund house as they know the style of their investing. The second one is fund category. I think we have already discussed this one. Then we have fund rank and ratios. So the ratios are too complicated. We'll stick to the fund rank. Fund rank is an important criteria. Most of the mutual funds are rated by CRISIL, which is the rating agency of mutual funds, and it gives a rating from 5 down to 1, 5 being the best and 1 being the worst. This ranking is based on the fund's performance over last few years and also based on their stock selection criteria and other parameters which is decided by CRISIL. It is better to remain with 5-star or 4-star funds because other funds are a bit risky as compared to the top ones. Then we have fund parameters. Here the most important is investment sector analysis. That means you can select a particular sector of your choice, and if you want to invest in that particular sector, then you can select the sector and then you can have a percentage allocated to it. So let's say if you want to invest in a sector that has exposure in capital markets, so you can select that parameter here and apply filter. After this, all the mutual funds will be filtered based on your selection. The next category is investment parameters. This is same as the investment type mode we already discussed. So now let's move on to a particular page of a mutual fund and see what parameters to check in them. Okay, before moving there is one more important point to be taken care of. Each mutual fund is available in two types. One is direct plan and other one is regular plan. Direct plans are the mutual funds where you invest directly in those funds. There are no middlemen involved. So the returns generated are a bit higher than the regular plans. In a regular plan, there is a middleman or a broker appointed to you by the fund house. In case of any query, you can always reach out to him. It is just like a traditional mutual fund which is sold by a broker and he charges a commission for that. So your returns automatically comes down. It is seen that over a longer period of time, direct plans give far better returns than the regular plans. So it is better to go with direct plan instead of the regular plans. Now we will see a particular fund and the key parameters on its page. Here we have example of Access Small Cap Fund. It is a direct fund and it's a growth fund, and the combination of both gives higher return to investors in long term. So here you can also invest monthly or one time based on your choice. You can decide the SIP amount and you can also decide the SIP date. Here you can see the chart of mutual fund. The market moved down due to Corona, so the mutual fund is showing a slight dip and then it recovered. You can select from different options. You can see the 6-month chart, 1-year chart, 3-year chart, 5-year chart and lifetime chart. It is suggested to see at least 3 years chart for your long-term investment. From my experience, if I want to invest in any particular share or a mutual fund for let's say 1 year, then I tend to see 3-year chart. If I have to invest for 5 years, then I'll see 15-year chart. So multiply your investment horizon into 3 and then check the performance of the fund or share for investment. Going below, there are other details mentioned here. It mentions the risk profile, the NAV, the date when the fund started, the fund size and expense ratio. Expense ratio is the amount which is deducted every year by the fund house for management of your fund. And here it is 0.44%. That means if you invested 100 rupees in this year and next year your amount becomes 105, then 0.44% of 105 will be deducted that year for maintenance of your mutual fund. SEBI has restricted mutual funds up to 2.5% of expense ratio. That means mutual funds can charge from 0 to 2.5% for maintenance of the funds. And here it is 0.44%, which is quite reasonable. Going below, the table shows the returns of the mutual fund as compared to the category and within the category. So the fund's return in year 1 was 82%, 3-year were 24%, 5-year were 21%. And since inception, so if the fund is more than 5 years, and as we saw that it was started in 2013, the annualized returns are 16.3%. As compared to category, the fund has given more returns, and these are the ranks of the fund in given years. So it seems in long-term investing, this fund has given better return and has better ranking. Going further below, so this is a matrix which you can fill and check how much amount you would have invested how much time ago and what would be the current amount and the current returns. This is a good feature to analyze past performance of any fund. Going further below, we can see the comparison of the fund with its peers. Listed out the fund name, the rating by CRISIL, 1-year return, 3-year return, and then the fund size of peers. They have also listed the pros and the cons. Going further below, we can see the holding analysis. This is very important to us. Here we can see how many companies is this mutual fund holding? What is the concentration in top 5 companies? What is the concentration in top 20 companies? How much percentage the fund has invested in equity or debt or cash? Generally, for equity oriented mutual funds, it is mandatory to have at least 60% of their investment in share market. And as we can see here, this fund has invested 91.8% in stocks. Going further below, we can see equity sector allocation. Through this, we can see in which sector the fund has invested, which are the top sectors and which are the bottom sectors. This is important because if you believe that a particular sector will do better in the coming future, then you should choose the mutual fund which has higher concentration in that particular sector. Personally speaking, I am not much of a fan of financial or banking sector, so I try to avoid shares or mutual funds that have large exposure to financial segment. But this again depends on individual to individual. The last important parameter is the holdings. This table lists out all the stocks in which the fund has invested in. It is very important to check out the name of the companies in which the mutual fund has invested. This will give you a fair idea where your money is going, and if you feel that a particular company or the particular list of companies is not suitable for you, then you can always select a different mutual fund. Like here we can see the company has invested in Galaxy Surfactants, Tata Elxsi, JK Lakshmi Cement, Narayana Hrudayalaya, and these are the top 5 companies in which this mutual fund has more exposure. So if you think that the top companies will not do better in the coming future, then try to pick the companies or mutual funds which you think will do better in future, because the combination of these companies distinguishes a good mutual fund and a bad mutual fund. If the companies perform well, the mutual fund's NAV will go up, and if the holding companies do not perform well, then the NAV and the return of the mutual fund will go down. So it is very important to have a look on the holdings of the companies. Just click see all and check out all the companies where the mutual fund have invested. Going below, you can check the fund managers who are managing this mutual fund. Checking the history and quality of fund managers is also important, because eventually the stocks for investment are selected by the fund managers, and if the fund manager is good, the mutual fund will do better, and if the fund manager is not that much capable, then the returns of the mutual fund will be accordingly. And lastly, I would like to bring your attention towards Nifty ETF, which is a very simple mutual fund. If you don't want to go through these complex analysis and you have limited time, just select Nifty ETF. Nifty ETF invests in only top 50 companies in India, that too in the same proportion of Nifty 50 index. So a Nifty ETF just replicates Nifty 50 and invests in the best 50 companies in India. Its graph is almost similar to that of Nifty 50. The returns are exactly same as the Nifty 50 returns. The most important point to note here is the expense ratio, which is only 0.05%, which is virtually zero expense ratio as compared to all the other funds. This is because the fund manager don't have to waste time in selecting the stocks. They have to only replicate whatever is included in Nifty 50, and that's why the expense ratio is very low in Nifty funds. Though you can invest in Nifty through futures market, but if you have to invest for long term, Nifty ETF is the best option. If we go below, we can see the holdings of Nifty 50 ETF. The holdings of Nifty ETF of all the fund houses will be same, because they all are investing and replicating Nifty 50 or the top 50 companies. You just need to check the liquidity of that fund. So that's it for today, and happy investing. If you liked the video, do click on like button and share and subscribe to my channel.